I'll be honest with you, for the longest time, credit scores felt like some mysterious black box to me. You'd hear people throw around numbers like 720 or 650, and everyone seemed to have strong opinions about what was good or bad, but nobody could really explain how the whole thing actually worked. So I decided to dig into this topic, and today I want to share what I've learned with you. By the end of this video, we'll both understand what credit scores actually measure, why they exist in the first place, and most importantly, how to improve one if it's not where you want it to be. Let's figure this out together. First, let me start with what I think is the biggest misconception about credit scores. A lot of people, myself included for a while, think that your credit score is somehow a measure of how much money you have or how financially successful you are. But that's not what it's measuring at all. Your Cybersactos credit score is actually trying to answer one very specific question. If we lend this person money, what's the probability they'll pay it back on time? That's it. It's not measuring your income, your savings, or your net worth. It's purely focused on your track record of borrowing money and paying it back. Think of it like this. Imagine you're lending money to friends. You'd probably be more willing to lend to someone who always paid you back on time in the past, right? Even if they didn't make as much money as another friend who was always late with repayments. That's essentially what credit scores are trying to capture, but on a much larger scale with mathematical models instead of personal relationships. Now, there are actually several different credit scoring models out there, but the most common one is called FICO SARS, which stands for Fair Isaac Corporation. FICO scores range from 300 to 850, and here's roughly how they break down. 300 to 579 is considered poor, 580 to 669 is fair, 670 to 739 is good, 740 to 799 is very good, and 800 to 850 is exceptional. But here's what I found interesting. You don't need a perfect score to get the best rates on most loans. Usually, once you hit around 740 or 760, you're getting access to the best terms available. So while it's nice to have an 850, it's not necessarily going to save you money compared to having a 760. Now let's talk about what actually goes into calculating your credit score, because this is where it gets really practical. There are 5 main factors, and they're not all weighted equally. The biggest factor, making up about 35% of your score, is your Northfoulish payment history GIRSAS. This is simply whether you've made your payments on time. Late payments, especially recent ones, can really hurt your score. What surprised me when I learned this is that it doesn't matter if you pay off your entire balance each month or just make the minimum payment. From a credit score perspective, both count as paying on time. The second biggest factor, at about 30% on our sales, is something called Your credit utilization size. This is how much of your available credit you're actually using. So if you have a credit card with a $1,000 limit and you have a $300 balance, your utilization is 30%. Generally, lower utilization is better for your score. Most experts suggest keeping it below 30%, and even better is below 10%. Here's something that took me a while to understand. Your utilization is calculated based on the balance that gets reported to credit bureaus, which is usually your statement balance, not necessarily what you're carrying month to month. So even if you pay off your card in full every month, if your statement shows a high balance, it could still hurt your utilization ratio. The third factor, at about 15%, is the length of your credit history aside our songs. This includes how long you've had credit accounts and the average age of all your accounts. This is why financial advisors often tell people to keep their oldest credit card open, even if they're not using it much. Closing it could lower your average account age. The fourth factor, at about 10%, is your Allsorts credit mix resource. This looks at the variety of credit accounts you have, credit cards, auto loans, mortgages, student loans, and so on. Having different types of credit can be slightly beneficial, but it's not a huge factor. And the final factor, also at about 10%, ours is Zoe's new credit source. This includes recent credit inquiries and newly opened accounts. Opening several new accounts in a short period can lower your score temporarily. Now, here's something important to understand about credit inquiries. There are 2 types. soft inquiries and hard inquiries. John or soft inquiries sauer happen when you check your own credit score or when companies check your credit for pre-approval offers. These don't affect your score at all. After hard inquiries happen when you actually apply for credit, and these can lower your score slightly for a short period. However, the credit scoring models are smart about this. If you're shopping for a car loan or mortgage, multiple inquiries within a short window, usually 14 to 45 days, are typically counted as a single inquiry. This makes sense because they know you're rate shopping, not trying to open multiple new accounts. So now that we understand how credit scores work, let's talk about how to fix a bad one. The honest truth is that there's no quick fix or magic trick. Improving your credit score takes time and consistency, but it's absolutely doable. If you have a low credit score, it's likely due to one or more of these issues: late or missed payments, high credit utilization, accounts in collections, bankruptcies, or simply having a very short credit history. Let's go through the most effective strategies for improvement. First and most important is make all your payments on time every time going forward. Since payment history is the biggest factor in your score, this is crucial. Set up automatic payments if you need to, even if it's just for the minimum amount. You can always pay more manually, but the automatic payment ensures you're never late. If you have any accounts that are currently past due, bring them current as soon as possible. The impact of late payments on your score decreases over time, but recent late payments hurt much more than old ones. Second, work on lowering your harsh credit utilization If your credit cards are maxed out or close to their limits, this is probably hurting your score significantly. There are a few ways to approach this. You can pay down the balances, you can ask for credit limit increases on existing cards, or you can spread balances across multiple cards to lower the utilization on any single card. One strategy that some people use is making multiple payments throughout the month to keep their statement balance low, since that's what gets reported to the credit bureaus. Third, if you have any for accounts and collections, consider dealing with them. This is where it gets a bit complicated, because paying off a collection account doesn't necessarily remove it from your credit report. However, some newer credit scoring models give less weight to paid collections versus unpaid ones. You might also be able to negotiate a pay-for-delete agreement, where the collection agency agrees to remove the account from your credit report in exchange for payment, but this isn't guaranteed. Fourth, if you have a limited credit history, you might need to build more credit verditors. This could mean getting a secured credit card, becoming an authorized user on someone else's account, or looking into credit builder loans. A secured credit card requires a deposit that becomes your credit limit, but it functions like a regular credit card and can help build your credit history. Now, let me address some common mistakes people make when trying to improve their credit. One big mistake is closing old credit cards. Unless there's an annual fee you can't avoid, it's usually better to keep old accounts open because they help your credit history length and your total available credit. Another mistake is thinking that carrying a balance on your credit cards will help your score. This is simply not true. You don't need to pay interest to build credit. Paying your full statement balance on time each month is actually ideal. Some people also think that checking their own credit score will hurt it. As I mentioned earlier, when you check your own credit, it's a soft inquiry and doesn't affect your score at all. In fact, monitoring your credit regularly is a good practice because it helps you catch errors or signs of identity theft early. Speaking of errors, here's something important. Your credit report errors are surprisingly common. Studies suggest that a significant percentage of credit reports contain some kind of error. That's why it's worth checking your credit reports from all three major credit bureaus, Experian, Equifax, and TransUnion, at least once a year. You can do this for free at annualcreditreport.com. If you find errors, you can dispute them directly with the credit bureaus. This process can take some time, but correcting errors can sometimes lead to immediate improvements in your score. Now, let's talk about realistic timelines for credit score improvement. If you're starting with a very low score due to recent negative events like missed payments or accounts going to collections, you might see some improvement within a few months of consistent good behavior, but significant improvement usually takes 6 months to a year or more. If your main issue is high credit utilization, you might see improvement more quickly once you pay down those balances, sometimes within a month or two after the lower balances are reported. Here's something that helped me understand credit scores better. They're designed to be predictive, not punitive. The system isn't trying to punish you for past mistakes forever. It's trying to predict future behavior based on recent behavior. That's why negative items have less impact over time, and why consistent positive behavior will eventually outweigh past problems. One thing I want to emphasize is that while credit scores are important, they're not the only factor lenders consider. Your income, employment history, and the specific type of loan you're applying for all matter too. A lower credit score might mean you pay higher interest rates, but it doesn't necessarily mean you can't get credit at all. Finally, be very careful about companies that promise to fix your credit quickly or guarantee specific score improvements. Many of these are scams or are charging you for things you can do yourself for free. The legitimate credit repair companies are essentially just disputing errors on your behalf, which you can do yourself, and helping you create a plan to improve your credit, which is really about the strategies we've discussed today. The truth about credit score improvement is that it requires patience and consistency, but it's absolutely achievable. Focus on making payments on time, keeping your utilization low, and being patient as positive changes compound over time. Remember, understanding how credit scores work puts you in control of improving them. It's not magic or luck. It's a system with clear rules, and now you know what those rules are. The most important thing is to start with whatever your situation is today and commit to building better habits going forward. Your credit score is just one piece of your overall financial picture, but it's a piece that you can definitely influence with the right knowledge and consistent action.